Okay, so let's get started. First of all, I just wanted some background. I just want to say this webinar is sponsored by 3 different organizations. It's sponsored by CHYE, Crown's Young Entrepreneurs. It's sponsored by EPI, the Emergency Parnas Initiative, and it is sponsored by the Marine Park Jewish Community Council. So that's what it's sponsored by, and this class we're going to talk about accessing financing. How do you get money for your business? Everybody knows that in order to be able to run a successful business, you need to have cash flow, right? You need to have working capital. If you're an existing business, you need money to buy inventory. You need money just to meet monthly expenses. A business can't run if you don't have money. If you're in a startup business, there's even more costs involved. It's actually the start of the business, right? You need to incorporate, you need to find a space, you need to buy startup inventory. Construction, let's say, there's a million other things why a person would need money for startup, to be able to start up more than an existing business. So obviously money, as they say, cash is king, and a person needs capital to be able to run a business. What we're going to do in this class is we're going to try to list as many options as we can to obtain financing, both for startups and for existing businesses. We're going to go through all of them, or at least most of them, or whatever. And again, since it's, we can only do this, obviously, this is a short class, so I'm not going to be able to expand too much on each funding option. So I'll just give you the basics, and you can reach out to me afterwards, and we could discuss further how a person can actually access that. And if someone has a specific funding option that we mentioned here that they feel that they can benefit from, they can definitely reach out to me after the class for more detail. So again, we're going to go through all the funding options, and then we're going to list the criteria and the eligibility requirements for each funding source. Okay, so let's get started. So let's first talk about just a little background before we actually start talking about the funding options. Let's talk about what a person needs to do to put his best foot forward to be able to actually access the money. Right? A person just wants to get money. It's not just, you can't just run in right away and start applying. There's some background work a person must do in order to put himself in the best possible position. For a lender or for an investor to want to give money, you should put yourself in the best possible position, and you should have a few things in order. And I'll just list a few of these things right now, just the person should make sure that they're aware of before they start applying for financing. The first thing I think very, very imperative that a person has is a business plan. Right? A business plan that details the long-term vision of this business. Should be done professionally, and it should outline the profitability of this business and what it's going to take for this business to be successful. Any lender or investor that's going to invest in you, they want to see 2 things. They want to see, number one, that this business is going to be profitable, and if they're lending you the money, if they're an investor, they're going to get their money back, or they're going to get ROI, as they say, return on investment, if it's an investor. And they want to see that you, the company or the individual who's running this business, that you yourself have the capability of running a successful business. So that's what your business plan should try to cover, basically listing the operational feasibility, that you can know the business and you know how to run it and it's going to run effectively, and that you have the financial feasibility to run the business, that you have the money, either the money you have on hand or the money that you're going to access applying for this funding, and show clearly how this money is going to be used to fund the business, and you'll have enough money to fund the business. But ultimately, that's what it is. Anybody that's lending you money wants either the money back or ROI. So you need to prove that. So again, you have a much better chance of getting the funding if you come in and you can show a well thought out business plan that details it to the lender or investor. The second thing a person should be aware of is to have solid financials, right? If you're an existing business and you're coming in and you're looking for money to grow your business further, so you should come in with showing solid financials, at least 2 years, the more the merrier, showing that this business is profitable and this business is making money, and with the money that they're accessing now through you is going to make the business grow even further. So again, any lender investor is going to want to see that. If you're a startup business applying for funding, they're going to want to see at least 2 years worth of projections, showing that's why you feel the business will make money, not just projections thrown out, but projections based on real market research, detailing exactly why you feel, again, based, you're doing a market research showing that with this money, with this business running the way it is, I'm going to make so-and-so per month, and base it off a marketing plan, market research. Anytime you show that to a lender investor, show that you're serious, and they'll take you more seriously. What else the person should be aware of? A clear plan for the money, right? If you're gonna borrow money, a lender and investor does not want the money to be used to pay back old business debt. That's not. They want that money to be used to promote and grow your business further. So when you're coming in, to give a pitch to a lender or investor, the pitch has to be that I have a successful business, or I have a great idea, and this money is going to be used to add this, to add that, and then I'll be able to service more clients, better clients. And that's the route you should go, as opposed to saying that I'm terrible. I guess a lot of this is self-explanatory, but I'm just going to put it out there anyway, because I've seen people who've done it that way. Say I'm in business debt and I need to clear it to be able to run the business effectively. And a lender or investor doesn't want to hear that. So again, the money should be used. You have a plan for the money and be able to articulate that to the lender. As we said before, going back to the last, making sure that your credit history is up to par. Right? As I said in my last class, nothing that says someone is irresponsible and not trustworthy, someone that has bad credit, with judgments and defaults, late payments, and most funding sources are going to check, are going to do inquiries, especially if they're investing money or lending you. So make sure that all that is worked out beforehand to the best of your ability. Nobody wants to lend money, like I said, to someone that doesn't seem trustworthy or responsible. So again, put your best foot forward. Try to clear. Try to clear as much. Try to clear the credit report as much as possible. Right. Okay. Someone's asking a question here. Someone's saying that it is having trouble hearing through the computer. I don't think there's any other way to listen in. I hope, is anybody else having problems? I think if anyone else is having problems, let me know. I think this is the only way to listen. Sorry about that. Okay, going back to, so other things to keep in mind before you apply for a loan. Another thing about a lot of these business loans are going to require you to have collateral, assets to put up against the loan. And some of the loans are going to require co-signers. So again, know what you're applying for. If your type of loan that you're applying for is going to need you to put up collateral or have co-signers, so have them ready so you can go in and saying that I'm ready for the loan and I have co-signers ready to sign up. Another thing a person should keep in mind is to have a clear idea of what you're getting yourself into, understand your commitment. Right? So if you're going to borrow money, you're going to have to pay back the money. So if you go to a lender and let's say they give you a loan of $50,000 over 5 years, 60 months repayment, that's a payment of about 11, let's say 5% interest rate over 60 months, $50,000, that's about $1,100 a month. Make sure that you're going to have the capability of paying that back, right, either through your business or through other means. But again, don't borrow money that you don't have any idea how you're going to pay back before you go in for the loan. Make sure that you understand the commitment, what it's going to cost you, what it's going to take to be able to pay it forward. And the last thing a person should just be aware of, again, is research all the different options there. As I said before, there are many, many different funding options. So before you actually go ahead with one, some have better payment terms. They give you longer, they give you more money, they give you better interest rates, they give you longer time to repay it. There are many, many different ones. So before you jump into one, research everything that's out there, see what is the best possible available loan for you. Anybody have any questions on what we've spoken about up until this point? We're going to listen and follow. So that's basically what a person should be aware of before they actually start applying. Because let's start talking about the different types of business loans that are out there. So obviously the best possible loan is going to be someone that has a business and is successful and needs money to grow the business further. And for that loan, the best way to go is a conventional loan, otherwise known as bank loans, or as an offshoot of bank loans, a small business administration loan, an SBA loan, which is given by the bank. If someone is eligible for those loans are obviously the best way to go. First of all, they give you the most money. Bank loans can give you about $3 million maximum. They'll lend up to $3 million. They'll give you the best possible interest rate. Bank loans today are about 5 to 6%. That's usually prime plus 1. And they'll usually give you the longest repayment terms, about 10 to 25 years to pay off the loan. If a person is eligible, the best possible loan is either an SBA loan or a bank loan. Let's just talk about what these loans are. An SBA loan, we'll talk about first. There's a few different versions of an SBA loan. Let's talk about just the actual 7A, the most basic loan. So their loan, basically, what is an SBA loan? An SBA loan is a loan issued by a bank, by a bank that issues business loans, but it's federally insured by the government, and they'll insure the loan up to 85% of the loan. So banks love this type of loan because they're assuming minimal risk, right? The federal government is assuming 85% of the risk. So this is, but it's issued by the bank, and the bank makes a profit on the loan. So this loan is a great loan, and it's something that banks are motivated to give. Issue with obviously since it's like I said, since their loan is federally insured, the terms are great. As I said before, you can give a few $1 million, interest rates low 5 to 6%, and payment terms can be anywhere from 10 to 25 years. So the problem with this is that, okay, hold on. People are complaining the audio is choppy, so let me just stop it and restart it. Let me see, maybe maybe it'll be a little better. Give me 1 second. Hello, is this any better? Anybody could just comment just to tell me if the audio is a little better. I have 2 people say that the audio is choppy. Okay, one person said same, one person said better. So, okay, good. All right, so people are saying better. So let's go with it. Obviously, comment if anything. Okay, so let's go back. So we're talking about an SBA loan. So the SBA loan again. So that's it's a set. I'll try to talk a little clearer. I'll try to talk a little slower and clearer. So the SBA loan again, I said, is the best possible terms. The terms are they give an amount of about $3 million maximum. Interest rates 5 to 6%, going prime, and 10 to 25 years repayment. The issue is that the eligibility requirements are tough. What are some of the eligibility requirements for an SBA loan? They want to see, first of all, obviously, again, this is going to be a criteria for most of the loans. They want to see a professional business plan detailing the long-term vision of the business, showing why the business is going to be successful or why it is successful, and you have operations in place, and you have your financials in place. They want to see solid financials. Obviously, this is SBA loan are only for existing businesses, 2 years in business. That's what they want to see in order to be eligible for the SBA loan. You need to be ready 2 years in business. So that means they're going to want to see a business plan, and they want to see financials for the last 2 years, preferably showing a profit, and how the money that they give you is going to be used to grow the business further. They want to see excellent credit, 700 score or above. And the last thing they want is collateral, which is usually up to 70% of the amount of the loan. So again, so this is tough criteria. As I said, you need to be an existing business, great credit, a business doing well, have collateral to put up against the business. So this is a tough loan to get, but if a person is in that position and they're eligible for it, the terms are the best, and it's a conventional loan. It's the best possible situation. So if a person is eligible, again, you can contact me, as with all these loans, and if someone feels that this is something that would work for them, we can help move this forward. And someone does not want, someone just says what's available for those who are startups. We're going to get to that. Right now, we're talking about existing. We're going to go through all of them. Someone wants to see if they want to see a personal credit report. Yes, in many chances they will look at the credit score, because they want to make sure they're giving the money to someone that's trustworthy and has a handle on money and is responsible. So they will do a credit check, making sure that your personal finances are in order and that you're a responsible person. Okay, so as a side to an SBA loan, you have the traditional bank loan that's run through the bank as opposed to the SBA. The criteria is basically the same. Why would someone want to use the bank loan as opposed to an SBA loan? Most of the main reason is just the turnaround time. SBA loan is through the government, so they could take it could take 2 to 3 months till everything is in order, till everything goes through. A bank loan, if you get all the paperwork, it could work within 2 to 3 weeks. It could be finished. Again, a person is eligible and has all these everything in order, as we said before. The criteria again of 2 years in business, 700 and above credit, collateral, business plan. They will probably be eligible for the bank loan for the great terms, but it's going to be the turnaround time will be quicker. So those are two great options. So again, so someone just asked me, is it the same interest rate as the SBA? Yes, it is. And the bank loan is not federally insured. The bank loan comes through the bank itself. It's different from the SBA loan in that way. Okay, so yeah, so that's basically the situation. As I said, someone was looking at the questions here. No, this is the bank. Again, the bank it's a for-profit. They'll be charging 5 to 6% interest over 25 years. They're making money off you. Don't worry about it. That again, obviously there are variables depending on your credit score. If the better it is, the lower rate they'll give. If you're 800 and above, they can give you like a slightly better. If you just meet the criteria for exactly 700 or 690, the rate will be a little higher. Don't worry about the bank. They're going to make money off you either way. Okay, so for those that are eligible, these two options are the best possible options to do two conventional loans, the SBA and the bank. Okay, now let's say someone is not in that position, right? They're a startup business, not an existing business. They don't have collateral. Their credit is not great. So there are other types of loans out there, and that for people out there that are like that they're startups, they don't have great credit, they don't have collateral. So there's a few different ways to go. So let's first talk about the micro lending options. So I'm going to talk about the interest-free loans, EPI, Hebrew-free loan in a minute, but let's first talk about micro lenders that are out there. There are organizations that will lend money to startups and people that are not in the position of having a history of having a business. But since they're assuming more risk, so the criteria is a little different. Their terms are, they don't lend as much money. They'll give anywhere from $5,000 to $100,000. The reason that's why I'm listing them first, obviously we can talk about interest-free loans by two great organizations in a few minutes, but they give maximum either 50 or 25. You can get up to 100,000 with these micro lending enterprises. That's what I'm talking about them. As I said, so they're assuming more risk because you don't have the history. So they're going to be maximum, as I said, anywhere from 5 to 100,000. The interest rates are much higher. It could be anywhere from 12 to 25%, depending on your credit score. Obviously, they're going to look at your credit. They want to see that you have okay credit without judgment and default. Talk about the actual criteria in a minute. Let's talk about the terms. So again, so it's 5 to 100,000. Interest rates of 15 to 25%. And in most cases, they're going to want to see that you have a co-signer. At least one guarantor. Some will need two co-signers to guarantee on the loan to make sure you pay it back. So what's the criteria for these loans? So again, like all the other ones, they want to see a solid business plan showing, again, if you're a new business, they want to see that you wrote a professional business plan and you laid out your vision for the business. And again, because their ultimate goal is that whatever they lend you, they're going to want to see back. So you have to show and be convincing in your business plan that your business is going to be successful. You have a long-term plan. You did market research. You show that this is going to make money. That's the first thing they want to see. They want to see a credit report. They're going to do a credit check. You don't need 700 credit. You can even have credit in the sixes. But what they will not want to see, they won't want to see judgments, defaults, late payments. These things are red flags. So again, if a person has a bad credit score because he has high balances, it's one thing. If you have a bad credit score because you have judgments and defaults, if you're looking for a business loan, take care of it because it's going to affect you every time. So make sure you try to get the judgments and defaults off. Again, and the third, and another very important thing that you need to show them is that you have some traction in the business. Right? They don't want a person just to come in with a business plan and says, oh, this business is going to be great. And they ask you, what do you actually start doing for the business? And you're not going to have an answer for them. So they want to see some traction. They want to see that you actually incorporated, you put in some of you have, as they say, skin in the game. You put in your own money. You developed a prototype if that's the type of business that it is. So again, they want to see that you have, as they say, skin in the game, that you actually have some traction. So this is a great, obviously the rates are high, but if a person's in a position where he's a startup business and he needs money up to $100,000, he can, with a great business plan, have decent credit without any judgments and defaults, a co-signer or two, and traction in the business, is a very good chance you'll be eligible for these businesses. I have here a list. We could talk about it later. I'm not going to go through all of them, but I have over here, there's about 10 different small business credit lenders. There's Axion, there's FX Federal Credit Union, Business Outreach Center, organization called Briscoe, Bushwick Credit Union Bank, Canva, Keyspan. There's about 10 different ones. I'm not going to share the list here now because it's a little too much involved, and I would rather talk privately afterwards if anybody wants to talk, because the criteria ranges is a little different for each one. So I'd rather go through the different, I'd rather not call them directly. So I'm not going to give the list, but there are a list of about 10 different micro lenders that I work with, and that everything, they vary, the loan size varies. Some give up to 25, some people give up to 50. So these are, again, for someone that needs that amount of money, this could be a very good option for them. Let me just talk about, since I'm talking about the micro lenders, we'll talk about there's another great option out there. There's an organization called the Business Outreach Center Network. They do business lending. They have something called a contract-based loan. Let's say someone has an online business and he gets a large order, $20,000 order for merchandise, but he doesn't have the capital to get the merchandise. He doesn't have the money to be able to fill the order. So if he comes to the Business Outreach Center with a contract stating that I have a contract, I just need to I have a contract, I just need the money to fill the order and ship it out. So they have a 30-day loan. It's a contract-based loan, and they'll give you the money, and it's a quick turnaround. You have 30 days to pay it back. The criteria is pretty simple. They give up to $75,000. It's 30 days, prime rate, 5 to 6%. You do a credit check to make sure that you don't have any judgment defaults and that you're a trustworthy person. And it could be, they usually want to have a co-signer, and they want to see that you could be either a startup or an existing business. Doesn't make a difference. If you come in with a contract, there's a very, again, if everything checks out, that your credit is good, no judgments and defaults, interest rate is very low, quick turnaround loan, you pay repayable once you make the sale, buy the inventory, you send it out, you get the money, you pay it back. But this is a great opportunity for someone that has an order that they can't fill. So there's something out there that you get very quickly, a contract-based loan through the Business Outreach Center Network. You can contact me for more information. Okay, so any questions on that before we move further? Okay, so let's move on to, I'm going to talk now about the interest-free loans. We work very closely. There's two organizations that, in my opinion, someone needs obviously up to $25,000 or $50,000 to start their business or run their business. The best place to go is the interest-free loans run by EPI, by Zisha Novoseller, one of the sponsors of this webinar, and the Hebrew Free Loan Society. Shlomo Haft is a loan coordinator that I work very closely with, and we've done many loans with. So again, this is obviously a tremendous opportunity for people that are either existing or startups with some traction. I'll talk about the criteria in a minute. But these two organizations are basically chesed organizations that they're lending, they're giving business loans to from and Jewish businesses, really to everyone in some cases, but mostly to from and Jewish businesses to be able to promote and grow entrepreneurship in our communities. So it's if someone needs $50,000 for a Hebrew Free loan, or EPI gives up to $25,000, those are two very, very, very good options. Let's talk about the criteria. So what they are, let's talk about the Hebrew Free loan first. So Hebrew Free loan, there is some to be able to get it. There are some eligibility requirements and income eligibility requirements. They require you to be living, first of all, in terms of income. It's not for everyone. It goes, you have to be either low to moderate income to be eligible for a Hebrew Free loan. Obviously, it varies depending on family size, but for just a matter of example, if you're a family of four, the maximum you can make to apply for the loan is $146,000 annually to be eligible for the Hebrew Free loan. Again, if you have, you can make more money if you have more people in your family. But that's just the baseline. So again, so there are income eligibility requirements, and you have to be living either in the 5 boroughs, Long Island, or Westchester County to be eligible. They'll give up to a maximum of $50,000 for a business loan. Maximum repayment terms is 60 months, which is 5 years. This is a board decision. That's the maximum. They can decide to give you less. They could decide to make the payment terms less than 60 months, but the maximum they'll give is $50,000 payable over 5 years. That's the maximum rate. They want 2 co-signers on the loan. Each co-signer making at least $60,000 a year. Can't be a husband and wife. It has to be 2 separate families. Also, the co-signers need to live in, again, those 5 boroughs, Long Island or Westchester County. They do credit checks. They'll do a soft inquiry on the guarantors. It doesn't really affect your credit at all. And they'll do a hard inquiry on the applicant to make sure that, as I said, they're responsible and they're people that they want to lend money to because they feel that the business owner has integrity and is fiscally responsible. They'll give up. It's mostly for existing businesses. If you're a startup business, they want to see a few months of sales. In most cases, they want to see that you are actually making some money. The business actually started and is making money. It's not a be-all, end-all. The board will give consideration if a person has prior experience in the specific industry. Then if they do have prior experience in a specific industry, then they will give that consideration. They will not lend to purchase real estate or construction loans. They don't give for that. And another good thing about a Hebrew Free loan is that they do not require you to come in with financials or a business plan. They work with different organizations, and they will help you put together financials and, in most cases, a business plan. So again, if you need up to $50,000, you have 2 co-signers. This is the first place to go because, again, can't beat the terms, interest-free, in a lot of cases payable over a long period of time, up to 5 years. So if you're eligible, this is the best way to go. Someone asked me, they don't require personal financials. They do require personal financials. What I meant to say is financials for the business, putting together, as you said, as part of a business plan, put together financials for the business. They will have someone help you do that. Someone asked, what if you can't find co-signers? It's a problem for this particular loan. If there are no sales, as we said before, also an issue. They want to see that the money, again, they pride themselves on people repaying all their loans, so they don't have many defaults. So they want to see that there are sales. As I said, they will give consideration for people that have prior experience in the industry board can consider that. So again, so that's Hebrew-free loan would be a great thing. The other interest-free loan is obviously EPI, run by Zisha Novoseller, and so it's a little bit of, there's some similarities, some differences, and they lend only up to $25,000. They have, again, $25,000. Their repayment terms are 34 months, almost 3 years to pay back the loan. One good perk that they have is that they give a 4-month forbearance, which means you don't have to make the first repayment of the loan until the 4th month of the loan, which is very beneficial. It helps a lot of people. They can let them try to get settled with the business. Also, they require 2 co-signers who live in the tri-state area. It's a couple of different eligibility requirements that they require. They want to see matching funds. Whatever money they're going to give you, they want to see that you have, as we said before, skin in the game, that you're also invested, and that if they give you $25,000, they want to see that you yourself also put in $25,000 of your own money or got from an alternative source. They're not the sole organization funding your business. They want a letter of recommendation from a shul rav to show that you're a trustworthy person. As I said, live in the 5 boroughs. And again, one major difference between Hebrew Free Loan and EPI is the fact that this loan is made specifically for startup businesses that are just new and starting up, or just very, very early in the beginning stages of the business. It's not for existing loans. Their goal and what they want to do is to promote new businesses in the community. So these are 2 great options. As we said, if someone needs 25 to 50,000, this would be the first route to go. No interest. If you have 2 co-signers, your credit is okay. You have some traction in the business, and if you're Hebrew Free Loan, these are 2 great options. One more thing with EPI, they don't require it, but they would recommend that you sign up. They have a lot of different mentorship programs. As part of, they recommend that if you're applying for their loan, to sign up to some of their mentorships to be able to learn and understand and do business in the best possible way. So any questions here? No, the payments, someone asked you if they pay the payments in a lump sum. No, you don't pay it over a lump sum. You pay it monthly over the terms of the loan. It's 36 months, 34 months, 60 months. You would make a monthly payment. They don't require a lump sum. Okay, so these are basically the loans that are out there. There are some different possibilities. If you want, you can reach out to me, and we can try to discuss further and see what the best possible options for you. Like I said, you have the micro lenders, people that are new businesses. If you're a new business, if you are eligible, so you can contact me and we can walk through the steps to give you the best possible, put your best foot forward, to be able to apply and receive the loan. Someone asked me, so the 2 interest-free loans that we talked about are the Hebrew Free Loan Society and EPI. Those are the 2 different. You can contact me more afterwards or another time for more information regarding these 2 loans. Okay, so let's move on from lending right now. Let's talk about another possibility. Just before someone has mentioned innovation loans, that's a separate loan. We're going to have to try to talk about that a little later. So let's just move on from loans from now, and let's talk about if someone wants to use an investor, someone to invest money into their business. Now, why would someone, go to an investor as opposed to a lender? An investor, you have to give up equity. You're already giving up part of your business. So there's 2 main reasons why a person would like to have an investor invest in his business. One would be, and just in terms of he's not, like we say, he's not eligible for the loans. He doesn't have, if he's an existing business, he doesn't have collateral. Or if he's a new business and he doesn't have the greatest credit, or for whatever other reason, he doesn't have, as we said before, there are no co-signers. Someone asked if there's no co-signers. He doesn't have the co-signers. The person that would like to make a pitch to an investor so that he wants to make, and he thinks that he'll be able to make the investor believe that he's a hardworking person who has a great idea and a great plan, and it's a great idea to invest in his business. So that's one reason why they would go to an investor. Another real reason why is just in terms of to cover that person's shortcomings. If the person is, let's say, strong in he's strong in sales, he might want to bring in an investor, someone, investor / partner who can fill in his weaknesses. Let's say the person's not great at marketing. He wants to bring in someone like a marketer who has money and capital to invest to be able to fill his shortcomings and be able to fill in the weaknesses and the gaps that he's short on, and the investor will be able to help him out. So again, so there are two main types of investors that people look to invest with. They're angel investors and VCs, venture capitalists. So let's just talk about what they are. And again, so it's, and get someone to invest in your company. It varies widely what the requirements are, because obviously based on the belief that person has that your business is something that's worthwhile to invest in. I'll just talk about the basics of how to put your best foot forward. So the first thing we'll talk about is a angel investor. What is an angel investor? An angel investor is usually someone that you know personally. It could be your manufacturer, your supplier, friend, family, someone that knows you and you believe, and they believe in your vision to run a successful business, and they're willing to invest in your company for a stake of equity in your business. Whatever, 20%, 50%, 80%, whatever you decide, if they believe in your business, and they'll invest in it. Now, how does a person go to an angel investor? What do they want to see? So again, so it varies a lot, depending on how well you know the person, how well that person knows you. They could have different criteria, but just, to put your best foot forward when you talk to an investor, these are just the things you should just think about before you go in and do your pitch to them. First of all, they want to see very well, as we said before, a well thought out business plan with long-term visions of profitability, long-term vision, and then you market research showing that this business is going to make money. They want to see that, make the person believe in you. You have the drive, you have the energy, you can make this happen. For someone like an angel investor, someone that's investing in you, they want to be able to look at you and trust you and see that you're someone that they can trust to be able to run a successful company. So be enthusiastic when you meet with them. Again, obviously, this is everything else has to fall into place, but come in strong, be confident, show that you can be, know how to run, you have all the tools it takes to run a successful business. They want a detailed plan of ROI, right? The main reason why they're investing is for their return on the investment. They want a stake. Let's say they want 25% of the profits of your business. So you have to basically lay out in the financials a detailed plan of ROI, explaining how much you're going to make per month, what percentage they're going to get to them, show them on paper based on real market research, so they see that they're going to get their ROI. And the last thing is obviously, to have skin in the game before you go in. Don't just walk in there and say, I have a great business idea, do you want to invest? Don't blow your shot before you start it. If you really are serious, get everything in order, incorporate or register the business, put in your own money, have some sales, have some contracts, walk in there with some traction and showing the investor that you're really serious about it. So again, that's to put your best foot forward. Ultimately, it'll be up to the investor to decide. But their main thing they want to see is are you trustworthy to be able to run a business? Is there a solid business plan with a plan of profitability and a vision of profitability and great financial projections showing the business is going to make money? And as I said before, a detailed plan of return on investment. The main thing they want to see is that they're going to make a profit. They're investing it not out of the goodness of their heart. They're doing it so they can make money. So that's for an angel investor. Other type of investor people look at, this is mostly for existing businesses and companies that are looking to grow. They're called VCs or venture capitalists. Venture capitalists are investment firms or companies that invest sometimes large amounts of money into companies that they do research on and they believe will be successful in exchange for equity. Why would someone go through a VC as opposed to an angel investor? One reason is because usually they'll invest in, again, it's not in all cases, but in general, they'll usually give a larger amount of investment. And also in terms of the branding, if a company can say they're affiliated in partnership and have an investment through a famous firm or a successful firm, and they can show in their marketing that they're partners with them, so it gives credibility to their own business. That's why someone would want a VC on board. And the criteria, again, it's the same thing. You're going to meet with them to put your best foot forward. Main thing they want to see, ROI, the most important thing, return on investment. So come in, solid financials, showing, again, don't just say, I hope it makes money. Real market research, showing here are the numbers. This is what I expect to make. This is going to be your return every month. And again, show that you're confident and that you're believable and that it's not just numbers thrown out there, but you did real market research. And you can show them that you can do it. Obviously, it's up to their discretion. But as I said, to put your best foot forward, that's the best way to go. The VCs do startups. Most cases not. They can. Again, they're in startups. As I said before, it's all based on how trustworthy and how you present yourself. The person comes in and he blows them away, they can fund startups. But in most cases, they want to see already existing business and showing that the business is already in operation and making money in order for them to lend. Okay, so like I said, you can definitely contact me. We have some investors that are willing to work with some of our clients. They're looking for people that have great ideas and great businesses. So definitely, if someone feels they're in position to reach out to an investor, you definitely can contact me, and we can talk more further and see what we can do to try to move that process forward. Okay, we're approaching the end over here. Let's just talk about a few other funding options. Another popular way another popular type of ways to access capital in a business is through crowdfunding. Give me 1 second. I'm sorry. There's a bunch of questions popping up. Whose money the VCs use? I mean, again, they're investment firms using their money, their company's money. That's the money that they use to invest. And again, they do real appraisals and they do real research into the company. And they decided this is the way it works. Like with businesses, also there are certain types of people in real estate and construction. When they buy a building, they do an appraisal to make sure that this building is worth the purchase. So the same type of thing with them. Okay, let's move on. It's getting very late, so let's just move a little forward. I'll answer some at the end. I'll try to answer a few more questions. Let's talk about crowdfunding. Crowdfunding is another popular way of people that they raise money for their business. Basically, what is crowdfunding? Crowdfunding is raising small amounts of money from large amounts of people. That's basically what it is, usually online. There are many different platforms online that a person can look at to be able to access it. So there's 3 main different types of platforms. Again, you can reach out to me, or you can just look online, do searches. There are platforms of different types of crowdfunding. The first one is donations-based. That basically, your selling point is that you're selling a product or service that's going to be a benefit to the community, and you want people to invest money for the betterment of the community. Is that by giving of your money, that the community will be better and will be and basically a good deed. A lot of nonprofits use these platforms. A very popular one is Charity, SHARIDY. They do this a lot. So that's one platform. So but there are many platforms that are donation-based. Someone is like a nonprofit who feels they have a service or a product that can benefit the needs of the community. You can reach out, tug at people's heartstrings and get people to invest, to put in money and invest based on that. A different platform is rewards-based. Rewards-based is that you're asking people to invest money because of the rewards. They're going to get either better access, better customer service, they'll get 20% off the first year. Whatever it is, you're asking people to invest money based on the rewards they're going to get for it. And this is also, there are platforms for that. And then the other platforms are equity-based. You're asking people to invest money, and based on the amount they give, they're going to get a stake in the company. So again, so that's became very, very popular these days. These are different types of, again, they're not asking they're hoping for large amounts of people. You go, you sign onto the platform, you give your pitch. Again, either it's donations-based, rewards-based, or equity-based. And you're hoping that your pitch is done well enough that hundreds of people sign on, and hundreds of people giving $10 each or $50 each, that could equal a large investment. So you do your research out there. There are many different platforms. They themselves can offer advice. Someone asked me if they offer advice. I don't know if he's referring to the investors or the crowdfunding people, but they both do. You could either speak to an investor for advice, or you can speak to some before you sign into a platform. They're going to tell you basically how to do your pitch the best possible way. So let's just finish up. So now then I'll just do some last resource, out of the box thinking, different ways to get money for your business, and then we're going to finish up. One is this is not really out of the box. A business line of this is just something that some people know about it, some don't. Before someone actually registers for a business and they open up a business checking account, most banks would automatically sign you up to a line of credit. They'll give you about anywhere from 5 to 10,000 line of credit. You can draw. It's not a loan; it's a line of credit that you can draw against whenever you need it, and as long as you pay back within 30 days, you don't pay any interest on it. After that, you pay prime. Again, it's just a good faith of the bank by you opening up a business checking account with them. Most of them will give you at least $5,000. Again, it's good to know even if you're a startup, do your research, see if what bank it is. It could give you $5,000, $10,000 as a line of credit, just to have a little bit of cash flow around. Credit cards, right? In my last class, we talked about how credit cards are not necessarily the best thing, and in most cases that's true. You can get into a lot of trouble, but just as someone feels that they're responsible, there are credit cards out there that they can give you. A business credit card can give you anywhere from $10,000 to $50,000, no interest, no APR for the first 2 years. So the person really is confident in their business, and they feel that they're fiscally responsible. That could be a good way to go, to put money on the card. Just obviously be very careful, after the period is up, interest rates could be up to 25 or even more, up to 25 to 30%. So be very, very careful with that. But that could be a viable option to some people. And the last thing, this is something I usually advise against. I know some people who did it, so I was thinking about even if I should mention it, but I'll mention it anyway because I know people who've done it and have been successful with it. It's a home equity line of credit. If someone owns their own home and has equity in his house, for example, let's say he has $300,000 left on his mortgage, but his house is worth $800,000. So that means he has $500,000 in equity, and a bank will give him, in most cases, if you're doing all the paperwork, will give you a home equity line, a HELOC it's called, for $500,000 up against a second lien against your house. So obviously, it's not a great idea to put up money against your house because basically your house becomes a collateral. So it's not something that I would normally recommend, but in some cases, the person has like a slam dunk or they feel that they're fiscally responsible. I've known people that do it. I think it's a last resort, but I figured I'd just mention it. So all in all, try to get to as many as I can. I'm sure there are some out there, there's some financing options that I missed, but you could reach out to me. If someone has any of the financing options that we mentioned, speak to any of you. We could talk more about it individually. And that's basically it. Let me just look at a few more questions here. Would an investor be willing to do a partnership in return of an investment? Again, every person is different, especially if it's an angel investor. You could offer whatever you want to them. If they accept it, it's great. So a lot of times investors want to just be a silent partner and just give money in exchange for equity. A lot of times they want to be an investor / partner and be able to fill in, as we said before, fill in the gaps of, if let's say he's good in marketing, he'll tell you, I'll do the marketing, you do the sales. People will do that for sure. Someone asked me to do line of credits, don't go more than 10K. They can. I'm just talking about someone that's starting a brand new startup that does not have much of a track record. There are some banks out there that will give you, by opening up a business checking account, will give you a line of credit of, in some cases, up to $10,000. It's basically a low interest credit card. That's really what it is. But it's good. It's like I said, so it's, you're paying 5% interest on a credit card for the life of the line of credit. So it's just a very good option. Okay, so that's basically it. Hopefully that was helpful. And if anybody has any questions, again, you could reach out to me. And have a good day.